think we'll make a start. So, well, good morning, everybody, on this beautiful, glorious Friday ahead of the bank holiday. Welcome to our latest webinar for 2023. I'm Chris Hill, senior partner here. Thank you for joining us virtually this morning. I'm sure the back garden and the sunshine beckons, but thank you for joining us this morning anyway. It gives me great pleasure to introduce Paul Mount, Deputy Agent for Yorkshire and Humber of the Bank of England. Paul lives in Sheffield and has a really good insight into how Sheffield's faring in Yorkshire and then how Yorkshire's sort of faring against the rest of the country. So we're really interested to hear his views today. Never so much really has the economy been in the news, and over the last few months, and certainly this week in particular, we had the interest rate announcements a couple of weeks back with another 25 bit rise from 4.25 to 4.5. But then on Wednesday, we had the good news that CPI had finally got back below 10% into single figures at 8.7. However, we've still got food prices in double-digit inflation territory, with prices rising at their fastest rates in nearly 45 years. And then only yesterday, we had the good news that the energy price cap had fallen by about 20%. So that's some positive news this week. So it really is a great time to host our webinar and welcome our speaker. Paul, I think, will speak for about 20 minutes, and then there'll be plenty of opportunities to ask questions. After that, we'll have a Q&A session at the end. So if you'd like to post a question, I know we've had quite a few in already, but if you'd like to post a question, please do so in the Q&A box at the bottom of your screen, and we'll deal with all of those questions at the end. So without further ado, it gives me great pleasure to introduce Paul Mount. Thanks, Paul.
Thank you, Chris. Few moves. Thanks, Robert. Moving us on. So thanks everybody for joining on what indeed is a very lovely sunny morning. So I hope you're all looking forward to the bank holiday. So as Chris said, I'm one of the bank's agents in Yorkshire and Humber. The Bank of England has agencies across the UK, and really as a network, we have two key functions. One is we speak to businesses like yours about how you see the economic outlook, what's happening for your business, and we build up a picture from that intelligence that helps inform the Monetary Policy Committee that sets the interest rates about what is really happening out there on the ground right now. The other part of the role is doing what I'm doing today, which is really explaining to people and answering questions about what the Bank of England is doing and why it's doing it. And that's, particularly on the interest rate setting side, which of course affects us all as households and will affect you as businesses. So if you move us on a slide, please, Robert. We're going to have a poll first, so we'd just be nice to know who's on the call. So if you could just respond to this, and we'll see what sort of mix of businesses we have. That's great. Okay, we've got a nice mix of firms, and I'm pleased to see we've even got some construction firms on. And given that it's definitely the right weather to be out there doing stuff, it's good to see that people from the construction sector have joined as well. So we've got a good mix of firms. That's great. Okay, if you want to move us on one, please, Robert, on the slides. So look, I'm going to do three things today, really. I'm going to give you a very quick bit of background about the role of the Bank of England. I know a lot of you will know this about the bank's sort of, the institutional framework, but it's a very quick overview just to remind people, really. I'll then say why inflation is so high. That's clearly something that's on the mind of businesses, and I'll then talk a bit about what we think the outlook is and maybe where we think inflation and interest rates are going, and say a bit about growth and unemployment as well. So look, very quickly, the role of the bank in the economy. We're ultimately a public body, and we have a dual mission which is set by government, which is around monetary and financial stability. The financial stability part is all about regulating individual banks, but also making sure that the financial system as a whole is stable. And then the monetary stability part is all about using the interest rate to influence inflation and bring inflation to the 2% CPI target that the government sets for us. So if you move us on, another one, please, Robert. So look, again, a bit more context. Low and stable inflation is important because it allows consumers and businesses to make spending decisions with confidence. So it's all about stability. That's why we have an inflation target. We measure inflation on the Consumer Price Index, the CPI, which is a sort of broad basket of goods, which reflects how much the typical household will spend on different goods and services. It's roughly 50% goods, which includes food and energy, and it's roughly 50% services, which includes things like restaurants, hotels, travel, holidays, and education. The government sets the mandate at 2%, so they set the 2% target. We don't have any influence on that target, and they give us a policy tool, which is the interest rate, to try and bring demand and supply into balance and meet that inflation target. And you can see from the figure that over a reasonably long period, inflation has been more or less around the 2% target. There's always a lot of variation, and that's to be expected. What we have now, of course, for the first time in a long time, is an unacceptably and worrying high level of inflation, which is having very negative impacts on consumers and businesses. If you move us on one more, please, Robert. I'm not going to go into any detail on this one. I'd really just say to people to sort of going from the left-hand side and the arrows at the top, just to remind people of what we're trying to do with the interest rate. So on the left-hand side, we set the official rate, the Bank of England base rate. That feeds very quickly into the market rates that commercial banks will offer. I have to say my mortgage provider is always pretty quick on telling me that my mortgage rate has gone up when the Bank of England increases base rate. I'm unfortunate to be on a variable rate at the moment. So they are pretty quick. So interest rates get passed through quickly for rates for consumers and businesses. That affects domestic demand. So if we increase interest rates, it reduces consumer spending and investment, reducing total demand in the economy. And with a sort of fixed supply side, that reduces domestic inflationary pressure and helps to bring inflation back in line with targets. One of the things I will always stress is that it can take up for 2 years for a change in the interest rate today to have its full impact on demand in the economy and therefore on inflationary pressures. And I'll come back to that a bit later on. If you move us on another one, please, Robert. So look, I'm sure you're all very familiar with this. Since the financial crisis, the UK's had very low interest rates, very cheap money. The interest rates consistently been below 1%. The bank cut the interest rate to 0.1% when COVID hit the economy. That's the lowest it's ever been in UK history. But since December 2021, following a sort of pretty significant increases in inflation, really from the summer of 21, the banks raised the interest rate by almost 4.5%. So we have a base rate now that is at 4.5%, and I'll talk a bit more about where markets think that might be going later on. If you move us on another one, please, Robert. So what's driven high inflation over the past sort of 18 months or so? I expect many of you are really familiar with this story, so I won't go into it in too much detail. But there's been a number of shocks to the economy. The first one was COVID. So COVID was interesting in the sense that it led to a real spike in demand for consumer goods. So looking at those orange bars, you can sort of see that consumer goods inflation picked up pretty early after COVID hit the economy, and two factors there played a part. One was on the demand side. None of us could go out, none of us could go on holiday, so we switched demand to goods. That happened globally in the developed countries, and then also on the supply side, particularly in countries where a lot of these consumer goods are produced, places like China, who had quite tough lockdowns. We had a hit to supply, so demand was exceeding supply, so goods prices got pushed up very significantly. Energy prices really started to pick up, I suppose, when Russia invaded Ukraine. So that's had a really significant impact, a direct impact on the consumer price index, but also an indirect impact. For example, food production is very intensive in energy. So those higher energy bills have also sort of fed through into really rampant food price inflation, particularly in the last sort of 9 months or so. And as Chris said at the beginning, we're still seeing food inflation is running at 19% currently, which is eye-watering, really. Services, you know, I said at the beginning, it's more domestically produced things, you know, like hotels, holidays, travel, education, meals out, and so on. That's something the Monetary Policy Committee looks at very closely. So currently, services is contributing on its own 3% to inflation. So even without all these goods prices inflation would still be above target. And I'll say a bit more about, you know, services and how we focus on that later on. If you move us on another one, please, Robert. Look, I won't go into too much detail in this one. On this one, it's a bit of a busy chart, but it's really just making the point that we've also got a very, very tight labour market, which you can sort of see as another shock to the economy, really. The thing that I'd pull out from this chart is the orange bars, which is showing since COVID hit, the proportion or the number of 50 to 64-year-olds who were previously working but are now economically inactive, so not participating in the labour force, has increased very, very significantly and has had a big contribution to the difficulty many of you will be seeing in recruiting people. And it's interesting, when you delve into that data, we find that a lot of those people in that age group who report that they're not able to work are also on NHS waiting lists. So again, you've got a sense of another negative impact from COVID hitting the economy, that the NHS is under strain, and for many people that's affecting their ability to participate in the labour force. So if you move us on, another one, please, Robert. So I'll switch now to talking a bit about the bank's latest forecast. We do a quarterly forecast. It has a 3-year forecast horizon. It's 3 years broadly because, as I said at the beginning, changing interest rates today can take, you know, up to 2 years to really feed through properly into the economy. So from the bank's perspective, we need to be trying to take at least, you know, a 2 to 3 year view to understand what the changes we're making today, how they might impact on economic outcomes in sort of 2-3 years. We always incorporate in that forecast the market implied path for base rate. So what do financial markets think the UK base rate is going to do? At the time of this forecast, the markets thought base rate would peak at 4.75% this autumn. They thought the bank would be cutting in March 24, falling to around 4% during 2024, and then falling to sort of 3.5% in 2025. Now that moves around a lot, and it has moved around a lot in the last few days, and I'll say a bit more about that later on, but that's the assumption in this forecast. Fiscal policy, we always take as announced. We never try and second guess government policy. You know, ultimately we are government owned, accountable to Parliament. That would get us into all sorts of trouble. So we don't do that. Energy prices are always based on the market futures curve, particularly for gas, and it's ultimately the gas price that tends to drive electricity prices. And as I said, the latest forecast was published a couple of weeks ago on the 11th of May. If you move us on, another one, please, Robert. So I'll say a little bit here about where we think inflation's going in the short term, you know, and also the longer term. So again, this chart is just breaking inflation down into some of its key components. So if we start at the top, we think goods inflation, excluding food, is showing signs already of coming down, and we think it's going to come down more. Electricity and gas, is certainly starting to come down. It was one of the big drivers for inflation falling to 8.7% in April, relative to 10.2% in March. So although electricity and gas prices are very high still, some of those really big increases that we saw last year are starting to drop out of the 12-month comparison. So CPI is a sort of 12-month comparison of prices. So that's starting to contribute significantly less to inflation and will help to bring inflation down more over the year ahead. Food and beverage prices still really high. We expect those to ease during the year, but less so, I think, than we had in the last forecast. So we think food price inflation will start to ease, but will still stay at very high levels into 2024. And that's partly because although commodities and energy prices are coming down, which is key input for food producers, a lot of them hedge ahead. So it will take time for those reductions we're seeing in sort of materials and energy prices to feed through into food prices in the shops. Services inflation, we predict stays fairly stubbornly high. It's currently running at about sort of 6%, so contributing a good 3% to the overall inflation measure. So we think by the middle of this year, inflation should be down to about 7%, 8.7% for the April figure, which actually was a bit above where we thought it would be. I think the bank publicly said 8.4%. So again, another surprise to the upside. Which in some ways is unhelpful. We think we'll end the year with inflation at about 5% and that we won't be back to target until the end of 2024. So a long path back to that 2% target. So there is some good news. Inflation is coming down from the terribly high levels we've had, but it's going to take time to get back to target is what we're predicting currently. You move us on, another one, please, Robert. Look, I won't dwell on this one. You're very welcome to have the slides if Hawsons are able to send them out to people who want them. But this is just showing that the futures curve for gas, has moved down significantly over the last 6 months or so, and the gas prices now are well below peak. So that's part of what's driving the forecast of lower inflation in the short term. If you move us on, another one, please, Robert. So look, I've just picked out this table really from the last report to focus in on what we're going to say about GDP and the unemployment rate. So sort of ignore the figures in brackets. The figures in brackets actually are from our February report. So you can see in the February report that we were actually thinking on GDP that we would have a recession. So a recession being 2 negative quarters of growth. Now, the economic data since then has been quite strong and quite positive, and we've actually upgraded the forecast significantly. So we now have, we currently think the economy is not growing at all, but we think broadly in the next 3 years, the annualized rate of growth will be around 1%. Unemployment, we think the labour market will stay very, very tighter than we thought previously. And we don't really see inflation getting above 4.5%. But you can see from those numbers in brackets that forecast has moved around a lot. And I would say that the economy is really volatile at the moment, and lots of big institutions like the bank, the IMF last week are moving forecasts around quite significantly. So there really is a high degree of uncertainty out there, and I think that will continue as people sort of upgrade and review where they think the economy is going. If you move us on one, please, Robert, I'll just pull out a few key messages here on sort of growth, employment. So one of the reasons that we've upgraded the GDP forecast is the energy prices. The energy price increases are going to be less than we thought previously in February. That's because that gas futures curve has moved down. So that will mean that the real income squeeze on households isn't as severe as we thought it would be in February when the prediction for gas prices was higher. So that will help, boost consumer spending above levels we thought previously. The labour market, I think, has continued to surprise us on how robust it's been and just the level of unemployment being so low. So that certainly helps to underpin certainty, I think, amongst consumers and amongst businesses, and will help to sort of underpin particularly consumer spending. We had some positive news, I think, from the budget as well. The budget in the short term, we think will give a bit of a boost to investment, so a bit of a boost to growth, and partly also a bit of a boost to consumer spending. But actually, as you get into the medium and the longer term, fiscal policy does tighten, so you start to see a bit of a drag from fiscal policy, particularly on consumption, as some tax rises come in and so What else do I want to say here? I think, you know, we have got growth. We are predicting growth, but it's still, you know, it's still weaker growth than we would like to have. Politicians would typically sort of target growth at 2 to 3%. It's partly because although gas prices won't be as high as we'd expected, just a few months ago, they are still high by historical standards. The supply side of the economy, you know, there are still some structural weaknesses there. The UK's had very weak productivity for a long time. So on the supply, the ability of the economy to respond to higher demand still remains weaker than we'd like it to be. And we've still got a lot of the impact of higher interest rates to come. So a lot of the increase in interest rates over the past sort of 18 months or so is yet to really hit consumption and investment. And I'll say a bit more about that as we move on. If you move us on, another slide, Robert, thanks. So look, this is looking at distribution of mortgages by product type. So you can see back in 2011, around 70% of mortgages were variable or floating rate. So if we change the interest rate back then, it would have a much quicker impact on consumers than it does today, because actually now we've got about 85% of households on fixed rate products. So about a third of UK households have a mortgage. We think there's about 1.3 million households who will have to move from a fixed rate product onto a new fixed or a variable rate by the end of this year. On average, they'll be paying £200 per month more for their mortgage. Now, clearly that's going to have a drag on consumer spending. So that means that, you know, the lag in changing interest rates on impacting consumer spendings via this channel of more expensive mortgages is taking longer. And if you move us on, another one, please, Robert. I thought I had another slide about investment. Have you flicked us on two by any chance? Yeah, there we go. Thank you. So really, this one is just bringing to the attention a sort of an investment survey of firms' investment intentions. And I suppose the key message is that companies that have debt still think there's going to be a negative impact on their capital spending in the next 12 months, which is still to come through. So, you know, lots of firms we speak to will say, you know, if you're halfway through a capital program, you generally can't just stop it, you continue. So again, with businesses, there's a lag in terms of higher interest rates feeding through into sort of lower investment spending. And if you take us on one more, Robert, I won't read through all this, but this is just some messages from the May Monetary Policy Summary. So the Monetary Policy Committee meets 8 times a year to set the interest rate. At every meeting, they will publish a set of minutes, and they will generally give some key messages about, you know, why have we raised rates, or why have we not raised rates, or lowered rates, and often give some indication of what they think the future will be. Now, at the moment, you know, the committee isn't giving any real indication of where they think rates might be going. That's quite different from maybe, you know, 6 months, a year ago, when they were quite clear that we were in a rate increasing cycle. What they're broadly saying now is that, you know, the economy is very uncertain at the moment. The data is moving all over the place, so they are very focused on that data as it comes in. And they've said that there's 3 key things that they'll be focusing on in terms of, you know, influencing their decision about what to do with the interest rate. So if you move us on one more, please, Robert. So the first thing they've talked about is, you know, labour market tightness. Labour market tightness is not good for inflation, because, you know, it means people have more wage bargaining power and wages will increase more. So there is some signs, I think, in the labour market of some loosening. On the left-hand side, you can see that vacancies to unemployment ratio is coming down. And on the right-hand side, the sort of flow of people moving from one job into another, so moving between jobs is starting to come back. And firms, I think, that I've been speaking to and across the network will say that some of their recruitment, typically will say that recruitment difficulties have eased back. But the message I often hear from people is, yes, they have eased back, but it's still very difficult. So it's maybe easier than 12 months ago, but on historical terms, it's still very difficult. So still quite a tight labour market. If you move us on one more, please, Robert. Now that's, you know, the tight labour market has been reflected in high wage settlements, and of course that's been driven by high inflation as well. So the purple line here is the KPMG REC survey of pay growth for new hires. Now that's fallen back quite significantly in the last few quarters, and that sometimes is a bit of a key lead indicator of where overall wage settlements. So you can see with the sort of surveys of total pay, the orange and blue lines, that they've just started to dip down. So there is, and I think from speaking to businesses as well, there is a sort of sense of a slight easing of pay pressure amongst the majority of firms. Pay settlements still historically very high, but a slight easing. So that's another sort of slug of data that the committee will be looking at very closely, where wage settlements are going. And if you take us on to the last one, please, Robert. The last thing they look at very closely is services inflation. Move us back one, Robert. You've skipped one again. That's it. Brilliant. Thank you. So services inflation currently running at above 6%. You know, you can see that that's very, very high. This is just going back to 2018, but typically services inflation sort of flatlines around 2%. So we're currently at 6%. It's roughly half the consumer price index basket. So even without all the goods inflation from food and energy, actually, you know, this is not consistent with a 2% target. It's more domestically generated. Often services firms have a high proportion of labour in their input mix. So a lot of this is driven by wage inflation. So another sort of metric that the committee will look at very closely in the months ahead as they think about what they're going to do with interest rates. If you move us on one, Robert, I think we've got another poll. So it would be interesting to think about, you know, we're thinking about wage settlements and pay per employee. So this question is all about, you know, where do you think your average pay per employee will be going over the next 12 months? Okay, so we've got the bulk of people are in the sort of 3 to 8% range. Actually, the majority at 3 to 5%. So that is, I think that result is probably consistent with the sense that, you know, historically that's still quite high pay settlements, but there is an easing back, maybe a wage settlement. So maybe there is some good news coming on wage settlements, and that of course would feed through into the inflation numbers. If you move us on one, Robert, please. I think that's actually the last slide, but let me just check. That's brilliant. That is the last slide. So I think Pete and Chris are going to facilitate some Q&A. Thank you.
Thanks very much for that, Paul. As ever, extremely interesting and illuminating to hear your thoughts around all that. So just as a reminder to everyone that's on the call this morning, down at the bottom of your screens, you should see a Q&A button that you can just press. And if you've got any questions that you'd like to pose to Paul, based on either what you're sort of seeing and hearing out there, sort of in the wider world, or specifically from what he said this morning, then please do just pop that into the Q&A function, and we'll look to put that to Paul. But as we mentioned, we did have a few submissions in advance this morning, so we'll just sort of look to tackle those in the first instance. A little bit of a reminder, just in terms of the questions, that obviously the Bank of England is not part of government, so try to keep the questions non-political where possible. But I know, Paul, you're normally pretty open on these things, and try to give a view wherever you can. So let's wade in, and the first one that I'm going to come to, potentially I suppose a little bit controversial, is whether actually the sort of the bank's actions on interest rates, and obviously the increases that you've talked about, Paul, are actually kind of having the opposite effect on inflation, and are actually seeking to, well, not seeking to, but having the effect of driving inflation higher in the short term.
Yeah, that's a good question, and and actually, you know, in a sense that there's a negative and a positive from impact on inflation from raising rates. So, you know, the negative part of raising rates is that it you know, it leads to a decline in consumer spending and investment, so lower demand relative to supply, so that reduces inflationary pressure. But because, you know, higher interest rates means higher mortgage payments for many households. You know, a third of households in the UK have mortgages. Number of those households, because will be working people, because there's lots of retired households, you know, who don't have mortgages. So, you know, that ultimately will mean higher mortgage payments for individuals, and will mean, you know, they will be looking for bigger wage increases from employers so that they can pay their mortgages. So that, in a sense, is, you know, is a positive impact on inflation from raising rates. The historical sort of data shows that the overall impact is still negative, so that raising rates does have, you know, does impact inflation negatively. But I think, you know, the questioner is absolutely right to say that actually there are some positive impacts as well, but overall the impact is seen to be negative.
Thanks, Paul. And obviously, as you can expect, I think a lot of the interest this morning, a lot of the questions are themed around inflation. So, I mean, in terms of sort of current pressures on inflation, where are we really sort of seeing that sort of stem from? I think you touched on it a little bit this morning, but food prices, utility prices, kind of elsewhere. What do you sort of really sort of single out as being a primary contributor right now?
Yeah, I mean, I think, you know, looking back a few months, it was clearly energy, and it was energy directly. So I think if we looked back at April, I've got the number here somewhere actually, April 2022, household energy prices increased by almost 50%. So now that big increase then has actually just dropped out of the index because they didn't increase by so much in April 2023. So energy has had a big impact. It's had a big impact, I think, in the sense of sort of looping back into other products. Food is an obvious one, that it is, you know, food is very energy intensive in production, and it's also impacted on services inflation. You know, pubs, restaurants, and so on have seen, you know, big increases in energy bills and had to raise prices in response. So I think, you know, going forward, the fact that energy prices are at least seems to be stabilizing or even coming back a bit is really going to help, I think, over time. Food price inflation, you know, I've talked about the energy impact there. You know, you've also had the fact that it's you know, its wages have had to increase. Other materials in prices in food production have increased. You know, a lot of commodities increased because of Russia, Ukraine, because of sort of agriculture. So there's been a lot of negative impacts on food, and it's going to take time for food prices to come back down, I think. But food prices, you know, at the moment are having a really big impact. You know, those should come back. I think on services, wage inflation is clearly also had a big impact. So, you know, we've almost had a sort of perfect storm, and a lot of firms would reflect this to me when I speak to them, of, you know, a wide range of input price increases, wage increases, which have just had to feed through into output prices for consumers, because, you know, firms at the end of the day need to try and make some money and stay, you know, keep their head above water. But you know, those pressures are dissipating, I think, and that's sort of what's driving that slow reduction in inflation back to target.
Thanks, Paul. And obviously you've spoken this morning about this fact that often it can be sort of, you know, 2 years before really the impact of those monetary policy decisions around interest rates can really sort of take effect. I suppose a significant part of that will be because of so many people being on fixed rate mortgages these days, that have taken some time then to sort of filter through. But what about the impact of how reliant we are in the UK on imported goods, energy, etc.? Obviously, our domestic interest rates and policy presumably has very little impact on those sorts of elements, and therefore what can the Bank of England do about what we see there in terms of the inflationary pressures from imported goods?
You're absolutely right, Pete, and the questioner is absolutely right that a lot of goods and also gas, we're subject to prices set on global markets, and the interest rate doesn't have any impact on that. Even if demand's a lot lower in the UK, we're a small part of global demand, so it's not going to have that sort of degree of downward pressure. And in a sense, that's one of the factors that has driven inflation to such a high level. When we're thinking about the impact of the interest rate rises, we're much more focused on the domestic part of the economy, which ultimately is services, things like education, things like restaurants, hotels, that are much more domestically produced.
So I think, again, a couple of people sort of raising the point here that it feels like actually there's sort of very limited sort of tools at the Bank of England's disposal to try and influence these inflationary pressures. So clearly there's interest rates themselves, but is there actually anything else that is at the bank's disposal in terms of trying to have an impact?
There is and there isn't. It's an interesting question. So the other policy levers that we have, that there's quantitative easing, or quantitative tightening, which is predominantly buying UK government bonds and effectively swapping them for cash. So we buy government bonds from, let's say, commercial banks, and we give them money in return, create money in return, sort of asset swap. That's a lever that we've used at times of huge stress on the financial system. So financial crisis. I think we did a bit more actually when we left the European Union, and we did a huge amount of quantitative easing when COVID hit the economy. It's more of an emergency measure to keep the financial system going. It's not a policy lever we'd want to be using as a norm. And ultimately, it works by changing long-term interest rates. So actually, it's still an interest rate tool. The other lever we talk about is sort of forward guidance, so trying to influence people's expectations of where inflation is going, but that's clearly not as powerful a lever as the interest rate itself. So we are limited. I mean, that's the framework, the economic framework we have in the UK. It's the framework that a lot of most developed countries will have an independent central bank that sets interest rates. I suppose that reflects the 1980s experience of governments being in control of fiscal policy, monetary policy, and tending to lead to very disruptive economic cycles. The government, of course, has a very wide range of tools that it could use to reduce inflation. It's restricted in how they would use them. That if they cut the VAT rate to zero tomorrow, that would have a pretty severe effect on inflation overnight. But because it would also bankrupt the government, so it's not something they would be able to do. But the government policy, of course, can have a very significant influence on inflation in the terms that they have expansionary or contractionary fiscal policy.
Thanks, Paul. And I guess maybe a slightly awkward one for you to answer, given it's your sort of boss is effectively sort of setting this. But in terms of the MPC and the decisions around sort of raising interest rates over the past sort of 12 months or so, clearly we have seen overall a very significant increase. But do you think perhaps they might have been sort of better advised to raise them more significantly, more quickly? Would that have more of a significant impact on? Yeah,
that's a really good question. Now, and of course, it would have had a more significant impact if we'd moved more quickly. It's interesting when we look back, inflation really started to pick up in summer 21, and the committee didn't raise rates until the first rate raise was December 21. When they look back at it, I'm pretty sure at the time they were very focused on the furlough scheme ending. So thinking back to mid 2021, the economy was still very weak. We still had the furlough scheme. We were still coming out of COVID. The sort of feeling then on the committee was that we would risk almost trashing the economy if we started raising rates before the end of the furlough scheme, because there was a sense actually that ending the furlough scheme might well lead to significantly higher unemployment. Now, as it turned out, the ending of the furlough scheme made absolutely no difference at all to unemployment. The labour market remained really tight, which added to inflationary pressure. So I think with perfect hindsight, if you said to people on the committee, would you have raised rates sooner if you'd have had perfect foresight of what was going to happen in the labour market? They'd have said, yeah, they would have done. And it would ultimately have had some negative impact on the inflation rate we see now. I don't feel it would be back anywhere near the 2% target if we'd moved sooner. It would still be very high. But yes, absolutely. And I hope that sort of gives a sense of, the complexity of the decision they're trying to make, particularly, when the economy was coming out of COVID, and the risk between high inflation and, adding more damage to the economy were really at the sort of forefront of their minds.
Thanks, Paul. And I suppose just moving slightly away from the inflation topic now, then, in terms of borrowings, obviously you showed us some stats earlier on around the mix between fixed and variable rates on mortgage products. Does the bank have much of a sense on what that looks like in the commercial world, in terms of commercial borrowings and the impacts that obviously interest rates have there on businesses?
We do pay on the financial on the sort of financial regulation side. We publish lots of stuff on on sort of corporate debt and so on. Now I'm going to struggle to remember the numbers, but I do know from the numbers that the corporate sector is much more exposed to variable rates overall, particularly SMEs actually. So it does have a quicker impact on the corporate sector in terms of what they're paying on their existing debt. So there is a more rapid impact there, that's for sure.
Yeah. And again, sticking with sort of borrowings, obviously what we have seen in recent weeks is in the market some 100% mortgages coming back out, obviously particularly sort of aimed towards sort of renters and helping those get onto the property ladder. But does the Bank of England have much of a view on 100% mortgages coming back into the market? Is that either a concern or considered to be a positive move?
I think from our role as the financial regulator, we would have an eye on individual institutions' exposure to 100% mortgages, because clearly, it's a more risky product. So we would have an eye on that. The bank does have a role alongside the Financial Conduct Authority in terms of regulating what institutions can do around mortgages and how much exposure they can have. So absolutely, yeah, they would have a view. In terms of, it's not a Bank of England view, but I think most staff at the bank, including me, would say, look, having 100% mortgages, which are issued to people who are financially secure and but can't save up for a deposit, seems like a good thing. It will help people get on the housing ladder, and it will underpin the housing market. But yeah, I mean, I think we, as an institution, we'd be looking at more side from the sort of risk profile of institutions.
Thanks, Paul. And again, quite a few times this morning we've talked about that tightness in the labour market, that being a sort of relatively persistent issue for quite some time now. I guess this might be more of a sort of personal view rather than a bank view, but have you got any thoughts around how or when that sort of tightness in the labour market may be alleviated? And certainly one participant has sort of said, particularly in the automotive sector, that they're really struggling to get young people sort of motivated, interested to join that sector, and maybe any sort of specific thoughts around that.
Yeah, I mean, I can give some reflections from what businesses, what the firms I speak to tell me, and maybe what they tell other agents around the country. So I think there's a lot of firms that will reflect that sort of tapping into a migrant labour force has got more difficult. I mean, we've just seen figures, for very high net immigration, and yet a lot of firms, I think, will say, it's harder to get migrant labour now. A lot of people, I think, will say it used to be very easy because we were in the EU and people could come very, very easily. And if they decided that living in the UK wasn't for them, they could go home very easily, you know, on an EasyJet flight for £100 or something. People now talk to me about going to, let's say, South Africa. The example particularly was to get engineers and welders, but it's costing them £10,000 per person, because it's a much bigger move to move from South Africa than it is to maybe pop over from an EU country. And they were even in a situation where they were actually having to provide housing for those workers because they didn't have a UK credit history. They couldn't get rented accommodation. So it's definitely more difficult, I think, to recruit migrant labour. A lot of firms, I think, you know, will reflect that it's a very competitive market for young people. Manufacturers, I think typically find it difficult. It's maybe a sector that's increasingly tough to engage the imagination of young people. I do speak to some firms who are doing all sorts of things to try and do that, but I think that's probably not going to change with the way young people look at the labour market. So it is really challenging, I think. I mean, that's some of the things that people sort of reflect back to me. The government's made some changes, haven't they, to policy to try and bring the 50 to 64-year-old people back into the labour market. Given that a lot of those people we know are on NHS waiting lists, and there's not a magic wand to wave and increase capacity in the NHS. Clearly, that's going to take time to work through, as well as people get the sort of health treatment they need. So my sort of personal view of talking to businesses is that the labour market is going to remain really tough for a period of time. It's difficult, I think, to see that easing back.
Yeah, no, I think I'm sure probably that's probably what most people are sort of anticipating at the moment. That it's something that's going to stick around for quite some time yet, unfortunately. Now, one subject that you did just sort of briefly touch upon as we're talking there, Paul, was around sort of Brexit, and again, trying not to get too sort of political around all this, but in terms of whether Brexit is sort of seen to be a good thing or a bad thing, obviously people will have their own personal views on that. But within the Bank of England and the impact of Brexit on the economy, is that something that is generally sort of discussed, and is it taken into consideration in decision making?
It is, and it's interesting that the bank did publish something on the impact of Brexit back in about 2018, I think. And we only published it because we were asked by the Treasury Select Committee, who we're ultimately accountable to government, that they wanted some analysis by the bank about the impact of Brexit. So there is, if people are really interested, they can find that. I think Bank of England analysis of Brexit or something will be somewhere on the internet, and we did publish some projections of the impact we thought it would have on the economy. I think at the time, it was certainly over time, over the medium term, we thought there would be a negative impact on GDP growth. And I don't think I'm going to put my foot in it by saying I'm pretty sure publicly some of the Monetary Policy Committee members have said actually that some of that negative impact has come through more quickly than we'd expected. We've never really said too much about the impact, the sort of the labour market availability impact, but certainly, I've already said from businesses, I think a lot of businesses would reflect that they've lost out because of the lack of availability of EU workers now, who often they would rely on, particularly for certain skills. Now that could be Brexit, that could be COVID, we don't know. So in terms of the future, the bank would only comment publicly on the impact of Brexit really if the government asked us to, which I'm guessing they probably won't. Internally, we'll be trying to work out the impacts Brexit has had and what that means for the inflation outlook. But we would never make a statement about if we thought it was a good or a bad thing, unless specifically asked to by politicians. And probably even then we might just say, well, we'd probably try and be fairly cautious.
Understood. And as we're coming back to sort of base rates again, you mentioned during the course of this morning, Paul, that obviously things are very dynamic at the moment. Lots of sort of factors constantly shifting, and that sort of forecast now for base rates. Obviously, we had previously heard that maybe around sort of 4.5, 4.75 might be seen to be the peak of where the Bank of England would need to go on interest rates. But inflation is proving to be rather more stubborn than people had hoped. So what's the current view, if it has particularly sort of moved in recent days, around where interest rates may end up heading to? Yeah,
it's a good question, Pete. So we get a sort of market update every morning at the bank, and part of that has, where financial markets think UK base rates going. And it always surprises me how much it bounces around. So I think I said, we always use the market expectation in the forecast. From memory, we take an average over 2 weeks. So I think in this forecast that it was peaking at around 4.75% in the autumn. This morning's figure is actually 5.5% in December 23. That's where financial markets think the peak is now. Now that's moved out pretty significantly in the past week or so. And I think that reflects higher than expected inflation number for April, 8.7%. I think the bank thought 8.4. I think a lot of independent forecasters thought lower. And some data that's fairly positive on where demand is in the economy. So it does bounce around quite a lot, that financial market expectation of where rates will get to. So yeah, interesting. So my sense was we wouldn't get to above 5%, but now financial markets think 5.5%. So yeah, it's a bit of watch this space. I think we need some good news on services inflation and wage inflation dropping a bit to bring that back down. Yeah.
Now I'm just starting to get slightly conscious of time, so I think we've just got one more that's come through from a participant this morning, which is talking about a tightening of rules for challenger banks, and I presume therefore then that the sort of impacts that might have on the availability of finance and debt in particular for SMEs, and what sort of thoughts you might have around the impact that could have across the economy.
Yeah, that's a really tricky one. I'm not always that well sighted on what we're doing on the financial regulation side, so I don't know what the plans are for tightening up on challenger banks. If the person who put that question is able to quickly type in something specific, I can maybe take it away and drop them a line. But I'm not sighted on. It's quite possible that on the financial regulation side we've published something on what our plans are for challenger banks, but I've got to be honest, the bank publishes a lot of stuff and it's not something I'm familiar with. So I'm sorry about that. I'm going to have to dodge that one because I have no sensible input to give.
I think that's quite all right, Paul. I think we put you on the spot quite a lot this morning already. You've coped with everything admirably. So, John, I can see you've given a brief sort of follow up there, but by all means, if you want to email me contact outside of the web this morning, we'll be more than happy to kind of pick that up and talk to Paul some more on another occasion. So maybe just one final one then, just so that we don't finish on a question that was too tricky for you. A question here just around that sort of basket of goods then that is used to calculate CPI. Obviously we do hear about sort of elements moving in and out of that basket. I suppose someone cynical might say, couldn't you use that basket to influence actually the amount of inflation that's being reported? I mean, particularly we hear about products like cheese, for example, where the inflation is certainly much more than sort of 10% or 20% on general food inflation. So I suppose ultimately, could that be manipulated?
I suppose the answer is yes, it could be. It's the Office of National Statistics that collects that. I mean, they collect it. They look at individual goods. So cheese would be a component of the food measure. So when you read about it in the press, they'll talk about general food inflation, but actually that food inflation number is made up of, well, at least hundreds, if not thousands, of product price collections. So the ONS has an army of people who actually go out to businesses to collect prices and actually do lots of scraping of the internet to get sort of price numbers. So it is, I think, to be fair, you know, the Office of National Statistics, I think, is a very professional civil service department that takes it very seriously, collecting the data for that index, and you know, the weights change, I think, once a year if spending patterns are changing, but they change slowly over time. So it is bottom up in a sense. It is made up of, you know, the price of a bit of cheese or some bacon or baked beans. It's not just an overall sort of somehow getting an overall food index from somewhere. So it does build up, and we tend to hear about in the press, I suppose, the sort of higher level bits, or we hear about something interesting when something new product has been brought into the index. But it's, you know, my feeling is it's a very robust national statistic. So I would be very surprised if anyone was trying to manipulate it to increase or decrease inflation.
Paul, look, conscious of time now as we approach sort of 10 a.m. I want to thank you, obviously, for giving up your time and sharing those sort of insights and thoughts with us this morning. And as I say, coping very admirably with all the questions that have been thrown at you. And equally, I'd like to thank everyone for joining this morning's webinar. I hope everyone that has dialed in has found it useful. For us as a firm, it's something that we're really keen to continue doing. I think people do find it very helpful, very useful. It's one of our most popular events of the year, so I'm sure we'll be following that up again this time next year. And hopefully, Paul, you'll be kind enough to join us yet again.
No, absolutely. It's part of the job, so I'm really keen to do it. And thanks for organising such a good event.
No problem. With that, I'll wrap up this morning and thank everyone for attending. Thank you.